a natural light coming in. So,
Okay,
uh,
Charmaine, it's good to have you. We are live. Yes, yes, yes. So we'll allow a few moments because, of course, if anybody decides to log in, oftentimes it's not immediately. Facebook sends out notifications and YouTube to let people know that we are live. So that's the
all
exciting
right.
news. But I'm glad that we are able to team up today. We had
Mhm,
a wonderful experience on the last closing that we had.
mhm,
I really was excited for my buyer because it was interesting that we had to make that change at the last minute and
mhm,
unexpected. We were working with another lender. The buyer decided he wanted to pursue other avenues because she had a better product that he was interested in. Tell us a little bit about yourself, Charmaine. You can go ahead and introduce yourself. As we everybody already know, of course, I'm Tisha Perry with New Life Realty Group. I'm the broker and owner of New Life Realty Group. We also have New Life Real Estate and Credit, where we actually help people with their credit and home ownership, credit coaching, life skill coaching. We pretty much cover a wide range of life skills for individuals to see their growth for other avenues in life. So whether you're looking to invest, buy, sell in real estate, we can help you with all those things and life skills as well to help you prepare for those things in the future. So Miss Charmaine Roberts is a local broker in the state of Georgia, and she's going to tell you a little bit about herself, allow for you to understand where she's coming from and who she is. Go right ahead, Charmaine. Looks like we got Charmaine. Are you there? All right then. Hello. I don't know. I didn't make any changes. Okay. Charmaine. Hello. Well, Charmaine got kicked out for whatever reason. This is Facebook. Facebook be Facebooking. So I'm sure she will try to log back in. As you all know, as I said, I'm a real estate broker, owner of New Life Realty Group. I've been serving real estate since 2005. I started out in Georgia, in Atlanta with Remax. That was the first company I went with when I first started at the age of 25. And I started investing at the age of 22, buying residential real estate properties in Atlanta, Georgia, where I'm born and raised. So, yeah, this has been a journey. A lot of things have taken place in the last 10 years. And I also have been residing in the state of Alabama as a broker. However, I service multiple locations, Georgia and Alabama, because Georgia is where I initially started at. So at this point, we are trying to see if she's coming back on since we had a connection issue. See. All right, she's back.
oh my
Charmaine, what
God.
happened?
So sorry. I just went black on this. I'm actually streaming from my phone. So I think what happened, I didn't put on my do not disturb.
Right, so
So,
that's why I
uh,
don't. That is, you're right. I forgot about that. I had to tell people that when you're using a cell phone, calls will come in, and it's going to cause you to get kicked out. So
yeah, and so I so apologize. That's so unprofessional. I apologize. I just want to make sure that that is
it's
on.
not a problem.
Think I
Life
think
be
I
happening, and I've already um, said my spiel. Of course, currently there's nobody on here, but this is a recording. So also, whatever we talk about today will also be on recording. So it's not a problem. I've already introduced myself and stated a little bit about who you were, but of course, I'm gonna let you go ahead and introduce yourself, your company, how long you've been in business, and what you're offering, and where you serve.
okay, yes.
Mhm.
So I am licensed in Georgia. I am a mortgage broker. So I have had my company for about 9 years now. and I have been in the mortgage industry for a little over 20 years and served in different capacities with banks there. Um, I am a mortgage broker, which means that I'm partnered with multiple lenders. I chose this route to go for my career because I wanted to be able to offer more options to the community of people. So if I was just a loan officer with one bank, I'd kind of be stuck with one bank's set of guidelines and what they're able to do. But because I am a mortgage broker and this is my company, what I get to do is be partnered with multiple banks nationwide that offer a bunch of different products. So it just makes me more competitive as a lender.
Right. Because as we realize that there's many companies out there, I deal with multiple brokers and lenders and also deal with certain products that banks offer. Each individual company has their unique products and services. And so I try to make sure that we partner with them to cater to each individual needs. Most banks can provide opportunity for individuals, but I let my customers decide what's best for them based on their financial situation overall. And Charmaine and I, like I said, we closed a deal a few weeks ago with a buyer. She had a good loan product, allowed for him to get 100% financing. They did not have restrictions on income, because oftentimes most of the down payment programs that are out there, they have restrictions on income. So not everybody qualifies for down payment assistance.
Mhm.
We oftentimes hear people say, do you have first-time home buyers available, products and services? We offer first-time home buyer products and services. And of course, FHA guidelines allow for anyone who's a first-time home buyer to do the FHA loan. However, there's going to be guidelines and restrictions as it relates to getting down payment assistance, because down payment assistance is not the same thing as first-time home buyer, or it's affiliated with first-time home buyers, but you don't have to necessarily be a first-time home buyer to actually qualify. It's levels to what allows a person to qualify for down payment assistance, 100% financing, these different loans available out there, such as FHA, USDA, conventional, and other different types of investment products and services. So today, Charmaine is going to go over a few of those things as it relates to what services she provides for her company, and go from there. I'm not sure if you introduced your name of the company. I know you mentioned about it. I'm just
It's
making sure. I don't
okay.
know if I heard it. I
Charmaine
could.
Robertson Associates.
Okay.
Woohoo!
She's with Roberts and Associates. That's the name of
Charmaine
her company.
Robertson Associates. Yeah.
Right, right. Okay. So as it relates to Roberts and Associates, what are the main what are your main focus with your company? What products and services that you offer
Sure,
that makes you
sure,
stand out the
sure.
most?
I do a ton of FHA conventional products as well as investor loans. The debt service coverage ratio program is a pretty popular one for the investors, and VA loans for our veterans. So that's mostly where I have most of my business.
Okay. And I noticed that you had sent me some information on your 5% down payment assistance option.
Mhm.
That 5% down payment assistance option, is it only limited to a certain state, or is various states is offering it?
Various states. So it's offered by a nationwide wholesale lender, and
Hmm.
wholesale meaning that they work with brokers like myself. They specialize in that, and they're nationwide. So that 5% down payment assistance is the product that we did together on your client, where the client just had to qualify for an FHA loan, and that 5% came in the form of a second mortgage on a 10-year term with a no prepayment penalty on it. So if you get your money together and want to pay that little nugget off, then you could do that at any point. Uh,
Okay.
it covered the 3.5% down payment requirement on the FHA loan, and then it also provided an additional 1.5% to cover some closing costs. And your particular client also had a contribution coming from the seller. So with all that together, it was a minimal amount that he had to spend at closing.
Okay. And the minimum, so oftentimes people, say, well, they know someone who's closed along with a 580 or less than less than 600 score.
Mhm.
Explain to, have you had any clients that have been able to close on loans with a low score like that? You know, oftentimes I try to explain to people there's various factors that go into play when the person does qualify for a loan
Mhm.
and end up getting it with low scores.
Mhm.
Everybody, that's not a one case scenario for all individuals because
Mhm.
there's various factors that are going to come to mind. It also has a lot to do with the money you have available.
Mhm. Mhm. And yes, so I have closed people with like 580, 590 scores. You need a minimum of a 580 to apply. Now, down payment assistance though may not kick in until you get to like a 620 mark. But if if you can close a loan with your own money that you've saved and some seller contribution, something to that nature, then yes, the FHA loan could be a fit to be able to
Yeah.
close. Hmm.
And the down payment for the 5% is pretty much for the FHA, not for conventional, correct?
That is exactly right. It is attached to the FHA loan only.
Okay. Now, with that particular loan that we had, the unique thing about it, the customer actually had funds to close. He had enough money that he could have brought and paid everything, but he did
Hmm.
not want to use his funds. He was able to keep his reserves because
Yeah,
he's ready for retirement.
yeah.
Oftentimes, most of the programs out there are going to have income restrictions. And of course, you got to meet certain credit scores to qualify for these programs. The one
Hmm.
that we just closed on, was it the 620 and above, or did you have to have like a 680 and above? Because I do know there's some out there, you got to have a higher score than 620.
This one you need a 620.
Okay, that's not
Uh,
bad.
Now I have more than one lender offering it. So
Okay.
that particular one, he needed a 680 and he had it. But now I have a lender
Oh,
offering the same thing down to a 620. I have another lender.
oh wow. Okay, so yeah, that's what I was saying. I know he had higher scores, and
Hmm.
I do have people that may have lower scores that may have some concerns because it may take them a while to get to 680 because they're coming out of the 500s. But 620 is not, it's not hard to obtain that basic score.
Yeah.
So that allows them to be able to qualify. But I'm assuming that those individuals who qualify to 620 still have to have a clean report. And that's where the credit repair program come in. They got to have their reports clean. You can't try to do it at 620, but you got $5,000 in collection dollars owed. It's going to be a problem, right? Especially if you're trying to get the down payment program.
Well, the down payment program, when it comes to the loan approval, is basically does FHA say yes? Because I don't have a lot of banks that have a lot of overlays on top of FHA guidelines,
Oh, okay.
meaning that as long as FHA says yes, then the bank is going to go along with that.
Oh, wow. So that's something I
So
like to know about.
collection, yeah, so collections are one of those things where there's some rules to collections. Like if you have over a certain amount of collections, then I have to include a percentage into your debt to income ratio kind of thing.
Right.
So that's not necessarily an approval or denial. That's getting into debt to income ratio if they're there. Collections are not hard nose. It just depends on the profile as a whole, because you have to remember this is a software system spitting out approvals. It's not a person like myself checking off boxes to say you qualify or not because you meet these certain requirements. It is literally your credit report, the application being ran through a software system called Desktop Underwriter,
Oh,
and that's spitting out the approval. So then you have banks that say, okay, we're going to roll with that approval, or we'll make it more conservative by adding our additional rules on top of it. And so that's how you can come up with certain lenders, even for the FHA loan, for example, and they'll say, okay, well, our minimum requirement is 620 just to apply for an FHA loan, because
so
their book of business with FHA a little more convey allows.
okay, so that's interesting because oftentimes when I do send people who have issues, once they get the pre-qualified letter that automatically happens, like you said, through a system, it still have to go through underwriting, and then oftentimes they come back, start asking for other things, or kind of find out they end up having to pay that off, or schedule to have it paid off, or settle the account and show that it's resolved before we can close.
Sometimes,
So
yes, sometimes that is the case. And the difference between like myself and that type of process, that's something that is as a mortgage broker, because I know how that can go, where people get pre-qualified by a software system up front, like go online or something with their local bank, and their desktop underwriter spit out an approval. That approval is only good, number one, as based on the accuracy of the information that you've given it. And number two, there are additional things we have to look at that system may not have taken into consideration. And what I do is a full pre-approval upfront. So my pre-approvals are not just pre-qualifications. I am looking at it just like an underwriter would look at it. So my experience in the mortgage industry and being a broker and speaking with tons of underwriters have given me the knowledge to be able to know what underwriters are looking for. And if I have to, I can submit the file even before a house is found to an underwriter to review, to get their conditional approval and decision on upfront. So it just depends on what's going on. But I never want to throw something up against the wall and hope it stick. So I'm going to know if I'm going to need either a question answered by an underwriter, or does an underwriter need to look at this full income situation, employment situation, or whatever it is, credit situation, before I issue a pre-approval letter.
I would say though, even though that there have been cases where buyers have been able to get pre-qualified with all the negative stuff still on their credit, in most cases, it is better to have a clean report, eliminate a lot of issues or concerns that may come up.
Yeah.
If at all possible. If you don't have to do it, then don't worry about it. But it's going to be counted. So it's everything on your credit, good or bad, is going to be counted in some way or form. And it depends on your income. And with today's housing market being high, if you can eliminate anything extra being added as a debt that you have to pay back, that will be the reason why you want to clean up the credit and avoid having those other issues and eliminate the negative things that are reported. Plus, does it impact your credit interest rate in any form or fashion based on the score? That's one thing a lot of people have concern about. The higher your score, the better rate. I know it varies, but I know sometimes it may not make that much of a difference depending on what product you're going with. It's pretty much set across the board. It's not like you're going to lose 2 points, but like buying a car. So what's your thoughts on the higher the scores versus someone who has a 620?
Yeah, so that's where being partnered with multiple banks gets really important in my role, because some banks are priced higher than others on certain credit score buckets. When I say credit score bucket, I mean, 580 to 600, and then 601 to 650. Like, there are tiers, and those tiers do affect the interest rate that you are quoted. Most importantly, not just the interest rate, but also the price of the interest rate. So when I start having interest rate conversations with my clients, and we are looking in more lower credit score buckets, I am speaking to them mostly about the cost of their rate. So if you have a lower credit score and I'm going to quote you a 5% interest rate, which is available these days, your 5% interest rate at 580 and the client with a 700 credit score, 5% interest rate are going to be two different costs. So yours will be higher, your 5% interest rate. The person with the 700 credit score, not only could it be lower, it could turn into a credit from the lender to help pay closing costs. It could turn into a positive for them. So that's where it really differs bank to bank to bank. It's not just the rate itself, it's also the cost of the rate, and your credit score directly drives that.
Oh, that's good to know, because I wasn't sure about that. I talked to some people before and they was thinking that it didn't make a huge difference as far as the rate they get. And because everybody pretty much was getting a similar rate because of the mortgage rates at hand, they felt like they want to get their scores in the 700s, that it was going to really help them more so versus being at a 680 or 640.
It just depends on the bucket. with that. So I would say that would be true if the score range is in the same bucket. So if the bucket is 700 to 750, and then that bucket is the same. Like, it doesn't matter. You don't need to get your scores up to 750 to get better pricing on your interest rate.
Right.
Changes with the tiers. So if you
The
want to
tiers.
go from a 580 to a 680, that could change your credit tier, and your pricing on that 5% interest rate will get better.
Okay. Now it makes a little bit more sense how that works.
Yeah. So that conversation could be true if it's in the same tier bucket.
Names here. But like if you like it's 640 to 680, is that going to be about the same tier or it changes after 660?
It depends on the lender. It totally depends on the lender. They can do whatever they want to do when it comes to pricing these things out. So wherever their sweet spot is and what they like is going to be priced the best.
Mm-hmm. I kind
And,
of figured that much.
you
And then
know,
we all now with the investor loan products and debt service coverage ratio, let's discuss that. What do you have for investors? I often deal with investors from all over
mhm,
looking to purchase in various areas, mainly particularly in Montgomery County, because they have a
mhm,
lot of good lower end properties that can be converted to rental or a fix and flip. So the products that you're offering relates to investor loan products. What do
mhm.
you have available?
The most popular is the debt service coverage ratio. That would be the most popular because we don't have to take into consideration an investor's employment or income. So that's totally not part of the application.
Oh,
Um,
wow.
a nationwide program, and even my company can do those deals nationwide. I'm not subject just to Georgia when it comes to investor purchases and refinances. So what happens is an appraiser is going to come out, appraise the house, give that value, and then also give a an amount of what they think the rent can be coming in. So you have that, and so the ratio of the loan is based upon, does the rents coming in cover the mortgage? That's the coverage ratio. And what we'd like to have is at least a 1-to-1 ratio, meaning, yes, this amount of rent covers exactly what the mortgage is going to be, the principal and interest, the monthly taxes, the monthly insurance. And if there is an HOA, the monthly HOA, what that would be in comparison to the rent coming in. Does it cover it? We want it at least covering it, hopefully more. There are some lenders that will go into, I guess, maybe the negative of it, that there is a little bit of a shortage um, that is available. But that's it in a nutshell. So does the rent cover the mortgage, debt service coverage ratio? And we do
Well,
that nationwide and in our
with
sleep. All right,
with
so
those loans, of course, since there's no income verification, and of course, if they're doing an investment property, they have to meet certain credit guidelines. I'm assuming you're looking at their bank statements and seeing they have savings or something like that. They have to have a certain amount of money in their bank account.
you got to have the money to close. So
Okay.
that becomes a standard, the same way we do any other loan program. You're going to have money needed to close, and depending on the bank, the reserve requirement changes. So and your credit score actually comes into play with some of these banks in regard to that reserve requirement. So it's a good idea to be on the higher side of your credit so that you don't need a what's normal is maybe 3 months reserve, 3 months mortgage payment sitting in a checking, savings, or an investment account after closings taken care of. But I've seen it increase to 6 months depending on that credit score. So it just depends on, because these banks are niche banks. They are not, these are not FHA, Fannie Mae guidelines. These are more kind of like private lenders, and they can structure it however they like. Even though the debt service coverage ratio program, there's a lot of these types of banks offering that program, they do vary a bit and where, this buyer is definitely going here, this buyer is definitely going there. Like, so I start looking at it more granular when I'm looking at the debt service coverage ratio program, because the guidelines do vary.
Okay. So obviously the debt service ratio program is basically income driven with the property, what income is going to be provided once they give you the loan. I mean, like what kind of income come source and the opportunity that it has to make to cover the expense of the loan. Question is, does the house have to already be rented before they even approve it? The house or the building or the property? Or is it something that they have to provide a market analysis about what the going rates are? Is it something that have to already be in place if
Mhm.
you're doing a rental property?
Sure. So no, it can be vacant. So what happens is there's always going to be an appraisal done. You're not going to get away from that. And the appraiser is going to do a rental analysis if it's occupied or not. So the appraiser is going to do the rental analysis, come up with the rental amount. The bank is going to go with that. As far as what the appraiser says. Now, if you have a renter in it, and let's say the appraiser comes in lower than what you actually have a renter for, like there's already somebody in place paying this rent, they're going to stay, or maybe you have someone that's going to come in once you close. Either way, and it's maybe a higher amount than what an appraiser says this rent is worth. Then what banks normally do is kind of come in between. They have sort of a calculation that they use, which is pretty much standard across the board, that they're going to give above what the appraiser says a little bit more. I want to say it's like a 25% variance, maybe something like that. Um, if you already have a proven person ready to go and a lease agreement signed.
Okay. So if you already have a person ready to go with a lease agreement signed, does that make the loan, the mortgage company more favorable to giving you the loan? If it has tenants or if it already has someone that's a potential renter, does it make it more favorable?
No,
It
no.
doesn't
So,
matter.
so the decisioning process does not include, is it occupied or not?
Is this a fixed rate loan, conventional loan for 30 years, or is it shorter terms? What are the terms of the loan in most cases? I know it's not a one size fits all, but for this particular loan,
Mhm,
is it a fixed rate? Is the
mhm.
rate much higher than a traditional conventional loan for an investor? What is the difference between someone having to do an investor loan and have the income verified versus the one that does not have income verification? How would
Sure.
that work?
Sure. So yes, these are 30-year fixed loans. I think you can go down to like a 25-year term or something lower than that if you like. And they are fixed products. As far as the difference in rate, now you have to consider these interest rates are going to be higher than any primary residence loan, because they are more risk to a bank. So these loans normally start, rates have gotten a little better. So I want to say high sixes, low sevens now.
Okay.
They were in the eights last
Yeah.
year
I
for
guess
sure.
it's almost like the same if you bought a commercial building. It's almost they were high when the rates went up. I was about to buy a building and my score is in 800s. I was like, why would it be 8%? I'm
Yeah,
thinking it would be because it was a commercial building. And I'm like, wow, that was a big
yeah,
deal.
yeah.
I learned some there. Like it depends on the type of investment. Now, I have buyers who ask me about no income verification for primary residence. Do you have a loan product for that? Is
No.
there a loan product so you don't offer that, but there is one. Because I know somebody,
Primary residence? No.
yeah, primary residence. So all primary residents require income verification.
Yes, that is a program of yesteryear prior to the market crash. So on a primary
Okay.
residence. So there is no loan program for a primary residence where you do not have income verified.
Hmm.
Not aware of anything like that in these United States. And the bank that's offering that, I would love to get to know them.
I guess what happens is if the person wants to get a property, they may try to say it's a rental property when it's not, just so they can get the home and then refinance later. That might be what they're doing. I don't know. I know someone said they bought one without proof of income because and then they're doing that loan, but they're living in it. So I didn't know how that works. I guess I don't know. Maybe it was bank statement loan. Maybe they did the bank statement.
Oh, but that's still proving income.
Okay, so that might be what it is. If you're doing a
Okay.
bank statement,
Yeah. Yes.
that's the
Yes.
difference. So you can use your bank statement if you haven't filed taxes and do the bank statement loan. What is that? What is it called in reference
Well,
to?
there is a bank statement loan. It is mainly for self-employed people.
Well, right,
Uh,
self-employed. Mhm.
yeah, self-employed people. We do not take into consideration taxes at all. No tax returns are collected, no tax returns are required to be filed, none of that. So it's made for self-employed borrowers. And what ends up happening is we'll take your bank statements from the last 12 months and all the deposits from those statements are averaged over a 12-month period, and then that turns into your monthly income to qualify the loan.
And those loans still have a higher rate, similar to what we're talking about.
Yes. So whenever you start getting into what I call alternative documentation, the interest rate is going to start getting higher
Okay, that's
because didn't you? So if I was able to use your tax returns, then I'd put you in an FHA or a conventional loan because that's what's required on self-employed borrowers. But if I can't use your tax returns and I got to do alternative documentation, I'm going to put you with one of my other private type lenders that offers that type of program. So the same lenders that offer the debt service coverage ratio programs for investors offer these bank statement programs for the primary residences for self-employed people as well.
and based on what I know about that, the little bit that I do know about that type of loan, the goal is to eventually refinance out of it. Like if you haven't filed taxes, or if you've made enough income where you like,
Mhm.
I'm ready to buy a house, and you don't want
Yeah,
to file taxes at that time, and you want to get
yeah,
this home, you get
yeah,
in because you know
yeah,
you're going to have a high rate. But the goal is to do everything you need to do within a year's time so that you
yeah,
can get out of that high end loan and
yeah,
move on with your life. Because otherwise, you're
that-
going to be spending a lot of money for that type of loan. But it's the
exactly.
benefits for those who actually have the income, who is not a stress. Because I know somebody might be paying 5,000 versus paying 3,000 by doing that loan.
Absolutely.
Depending, easy, because of the type of loan that you have and the interest rate that you're paying will make a huge difference in your monthly payment. Now,
That's
we mentioned previously you had told me about the jumbo loan programs that you're also offering. What is a
mhm.
jumbo loan?
A jumbo loan is $1 over the conforming limit. So right now, the conforming loan limit, where's my notes, is 766,550. So Fannie Mae says you can do a loan up to that number and have a conventional loan. Anything over that is what's called a jumbo loan. And so
Hmm.
a jumbo loan, and depending on the bank, can go up to maybe 3 million. So $766,551 up to maybe 3 million in loan amount is a jumbo loan. And it normally requires a little bit higher credit score, maybe like a 660, I believe, on the jumbo. And normally a higher down payment as well, maybe like 10% starting down.
Okay. And then, so I know you mentioned that you can use your personal and business bank statements for income verification. So does that mean that you're going to have a higher rate because it's a jumbo loan and you're doing that, or because you financially be obviously that puts you in another category, as well as the fact that it's a higher end loan? How does that work as it pertains to the jumbo loan? You said that it's going to be for the higher end products, right? The jumbo loan. Um,
Mhm.
does it
Yeah.
make is the interest rate going to be a little bit better because you put more down to help you have a lower the payment where it's not so high? Does it make a difference?
Uh, no. It's just that because we're dealing with higher loan amounts, the it's called a loan to value. It's normally maxed at 90%, meaning a minimum of a 10% down payment just to play in this.
Okay.
So, but what's good is Fannie Mae is actually increasing that number for next year. So 2025, that number is going to go to 802,650, the conforming loan limit. So people can get into an $800,000 loan amount and still be playing in Fannie Mae conventional guidelines. Now, FHA is a little different. They normally don't go as high as Fannie Mae does on their loan limits. FHA will be a bit more conservative on their maximum loan amount number than Fannie Mae will. But in 2025, it's going to move to 802,650, but it'll still be 10% down on.
So is
Oh, oh
500,000 considered to be a jumbo loan? Is 500,000 a jumbo loan?
no, no, it
Okay.
is not.
Where does a jumbo loan start at? 700?
$1 over the conforming loan limit. So in 2024, right now, the conforming loan limit is
Oh.
766,550. Once you go over that number, that's a jumbo.
Mhm. Oh, okay. Okay. So that's a jumbo. So no matter, basically, even if you got good credit, or even if if you're going that high, it's pretty much goes into that category.
Exactly. Exactly.
And only people that will be qualifying for that, if they meet those income requirements, they're in that category of purchasing homes in that range. Otherwise, it didn't necessarily apply to anybody who's trying to do a traditional FHA or conventional loan, because those loans are going to be a lot lower.
Well, yeah, using 500 as a number, FHA goes up to 500 as well. So you wouldn't be it depends on where, because you're in Alabama, right? Like your main.
Well, yeah, I do Georgia and Alabama, but my primary residence is in Alabama. Yes.
So now Alabama is a little different with FHA loan limits, because where Fannie Mae loan limits are nationwide and only change and go a little higher for high cost areas like maybe California, Hawaii. FHA is literally county to county.
Right.
So loan limits in Alabama is not going to be the same as loan limits in Georgia. Like, they're actually different, county to county. Now, I did do a little research on Alabama. All the counties happen to be the same loan limit in all counties of Alabama. Georgia is a little different, higher limits in Atlanta and vicinity. And then when you get out to more rural areas, they come down just a little bit. But so that Alabama's is 498 to 57 to be exact, is the maximum loan amount FHA will go on any one unit property in Alabama. In Atlanta, the number is 649,750.
Okay, so it can go up that high to
In
FHA.
Los Angeles, it's a totally different number. So it just,
So the cost of living is more in Los Angeles.
yeah. So FHA varies by county. Fannie Mae is a nationwide number, with the exception of high cost areas.
Okay, that makes a lot of sense, because oftentimes we don't know, because it varies by, like you said, the state, the county, location, cost of living. Alabama
Exactly.
cost of living is low, but actually depends on where you're at in Alabama, because Alabama can get high if you're going
Yeah.
to Auburn or Huntsville. I mean, Georgia can be high, but if you're in Macon, it's going to be less.
Yeah.
Columbus, Georgia, less than Atlanta, but it's still the major city. It goes by based on what the overall is, the
Yeah.
norm.
What's
And
going
so,
on in counties?
and I live in Prattville. The cost of living in Prattville is higher than Montgomery, but
Yeah.
but there's still high end properties in Montgomery. We have $1 million homes in Montgomery County.
Yeah.
So it really depends on where you at, what you're trying to do, and it all boils down to your income. We have an issue with income, obviously, across the board with a lot of people, based on where they live at, because the cost of living has gone up. They're paying high rent, but they can't afford to qualify for the loan that will give them that. So somebody might be paying $2,000 for rent because they're sharing an expense with someone. But when it comes down to qualifying for $2,000 mortgage, it can be a problem. So income plays a major role in what type of product or service you're going to be able to qualify for, as well as if you can qualify for some of these products based on credit. So with credit, income, and the reserves, I think the reserves make a lot of difference as well.
So when you're talking about income qualifying, the other piece to that pie is the debt. So monthly debt on your credit report is what I'm looking at, and any other obligations you have out there, like child support, alimony, that type of thing is taken into consideration as well. But your monthly debt in comparison to your income is where a challenge could be for people. So it's really important not only to have good scores, but to try to keep that monthly debt as low as you can.
Based on what the things that have happened in the last 12 months with the rates adjusting and then the ups and downs with that, what's your thoughts on the market update, where we are today, based on your level of expertise in the market where you're doing loans? I'm assuming that you do residential, commercial, as well as you may do refis. What's your thoughts on what's going on with this? Some people are waiting to after the election or feeling like that's going to make a difference in the interest rates available. What's your thoughts on that?
The interest rates have already adjusted, and they're pretty much going to stay steady for the rest of the year.
Okay.
So
And
it's
go ahead.
not going to be this big swing. Number one, we're not going to see 2 and 3% again.
Right.
So,
It wasn't
right,
even that long. It was very short lived. I was like,
yeah,
two people that have it. I'm like, where did you get that? How did, and it was very short lived.
yeah, that was just to keep the economy going through COVID. So some
Hmm.
sort of thing has to catastrophe has to happen like that to make the government push the rates down that low again.
Hmm.
But where they're sitting now is pretty steady. So I'm quoting, if I'm not dealing in down payment assistance land, 5%, 5.1 is very easy, without a lot of discount point attached to it. And it's pretty much going to stay in that realm for the rest of the year. It's not going to be another big decrease, to try to get the economy moving again, because we're moving pretty good.
Makes
So
sense.
I say that now is the time, because the rates have already been reduced. And if they do reduce again, it's not going to be a big swing where you're going to notice it like that.
Right, right. So I do know that at the end of the day, when the rates do drop, if they should, buyers have already figured it out. They're starting to buy again. And then I've
Mhm.
had some people say, "Oh, it's the rate too high to buy." I'm like, "What are you talking about? People had higher rates than this. When I bought my house 20 years ago, we were at the 6 and 7. Some people even had 8s,
That's
and
right.
so the house of homes were less. The
Mhm.
thing that people don't understand, the cost
Mhm.
of home is going to keep going up. That
Mhm.
is the point of being a homeowner, because being a
Yeah.
homeowner allows for you to sustain your cost of living for your residents. Now, cost of food may go up, taxes may go up, but at least you won't have to worry about paying a whole lot more for a place to stay because you wait too late in life to do so.
Yeah.
As we age, the cost of living is going to rise. We can think about when you were a kid, buying candy was a lot less compared to
Right.
buying candy and chips now. Even
Right.
penny candy is no more. You might find somebody who's offering, but on average, when you go and buying groceries, everything is much higher. And that's pretty much part of life. The cost of living will always rise, rent
Mhm.
will always rise, homes will rise. Once you become a homeowner, that's the goal, is to get equity. So if you were not building equity, you would be able to stand still. You would not be able to, it wouldn't make that much of a difference when you get ready to sell your house to do an upgrade, or when you want to leave it to your family members. Whatever you choose to do with your property is yours. But if you don't own anything, and the older you get, the cost of the homes in the market is higher, and you also get less. Not
Yeah.
only is the house costing more, but the size, square footage, and the land lot size, you get less.
Yeah.
So you have to see where your income is going and figure out ways to a strategy to increase income so that you can get what you want and get stabilized. And
Yeah.
this is not something to put anybody down. Now, this is just like we all have to do that, including myself. I have to make sure whatever moves I make is in line with my income and
Yeah.
not going outside of that and struggling. And so, in order for you to do that, you have to have a strategy. If you're currently not a homeowner and your goal is to own, what is your strategy? What is your income situation now? How much you're paying for rent? Where do you see yourself in the next 5 years financially, so you can be in
Mhm.
line with what you want? And so oftentimes you might not get your dream home, but what you can get is stability. The house, there are still nice homes that are quality that you can move in that make sense. When I
Mhm.
say make sense is obviously if you don't qualify a $500,000 home, you shouldn't be looking at that. You shouldn't be looking at 300,000. You will be looking in 200 or less, or within 250 range. There's still homes within 200, 250 range in Georgia and Alabama. But what I find is people are paying such high rent or renting these homes that are more luxury. They're paying higher rent, but when it's time to buy, they can't qualify for those particular homes that they're renting.
Mhm.
So what does that mean? There's an income issue, and or the location. If you're flexible with location, you may can still get new construction. There's still some nice new construction and reasonable price range for you to be able to get something and get a good rate with a new construction as well. So anyway, that's just my tidbit, and that's where I close out on what I have to say for today as relation to the market. You have anything else, Ms. Roberts, that you want to say before we end the call?
No, I am here to answer any questions anyone has. I can be reached at 404-796-8410 is my office line. And I am also on Instagram and Facebook, Charmaine the Lender on Instagram. And you can just Google my company on Facebook.
Okay, yes, and this video will be reposted, and we'll be providing you guys information in the future. Any questions you may have, you can reach out to me, direct message. You know, most of you guys are following me on my Facebook page, and you know I'm Googleable. She's Googleable. You can pull us up. All you gotta do is type name in. You should be able to find us. And if you have any questions, you're more than welcome to reach out. You can send a direct message. The goal is to help you reach your goal. And getting the information to the community is what we want to do, is making sure you understand where we stand and how we can help you, whether you use us or not. Having knowledge is power. If you don't have knowledge, you don't know where you're going, then we can't go anywhere without having the knowledge. So it's a pleasure, and we're going to end this live stream. You have a great day.
Thank you. It was great.